Hello and welcome to Pro Trader Strategies Market Commentary for Friday, June the 30th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We do have a lot of economic data to go over. So across the pond, we got German retail sales came in better than expected at 0.5%, was expected to be 0.3%. We also got French consumer spending slightly higher than expected at 1% versus the expected 0.5%. They did slightly revise down the consumer spending from the last month. And then we also got French preliminary CPI coming in at unchanged, and they revised last month's down to unchanged as well. And then German unemployment change came in at 7,000 more unemployed people filing for unemployment. Is expected to be negative 10,000, so much higher than expected there. And they also revised last month's slightly higher as well. And then we got Great Britain's GDP coming in line with expectations at 0.2%. And we also got the European region consumer price index, the CPI flash estimates at 1.3% was expected to be 1.2%, and that was the year over year. The core CPI flash estimate year over year also came in slightly higher than expected at 1.1%, expected to be 1.0%, so 1%. And then here in the United States, we got our core personal consumption expenditures in line with expectations at 0.1%. They did slightly revise down last month's number to 0.1% as well. Personal spending in line with expectations at 0.1%, and personal income slightly higher than expected at 0.4%, expected to be 0.3%. One would think that that's a little bit better. Personal income going higher would lead one to believe that personal spending would go up as more income goes into the pockets of the consumer or the person, the retail person. But they did revise last month's down by that 0.1% as well. So they kind of wash each other out. Then we got Chicago PMI Purchasing Managers Index came in at 65.7, expected to be 58.1, so a lot better than expected there. And the revised University of Michigan Consumer Sentiment was revised up from 94.5 to 95.1, so better on that front as well. On to the overall markets. Now, yesterday I was talking about crude oil looking like it might be topping out now that it had gone up and hit that Fibonacci 61% level and failed it. Today we are not getting confirmation to the downside with this candle as of yet. We got this engulfing candle in a sense and back above that 61% Fibonacci level. We need to have, if you are a bear, crude oil to come down and settle below this 44.61-ish area, so 44.50. If it settles around 44.50, that would be confirmation to the downside. As of right now, no confirmation, so the bulls will probably be celebrating that and looking like we want to get back up into the value area where the most time and volume has been spent, about 70% of that time and volume. So if we do get up into that area, we could easily see the market want to trade up to this Fibonacci level, which is the 50% area. All right. So out of the woods for the bulls that we are kind of breaking up and away, but it is still in a bearish trend. So we're seeing still consistent lower highs and lower lows. This would really need to blast off to kind of break that trend and get up above 50 some odd dollars a barrel, $52 a barrel, in order to break that trend. So it's not completely out of the woods, but the bulls will be celebrating getting back up into that $45 a barrel mark. Then on to gold futures. They're off a little bit as the overall equities are kind of rebounding. They were still off yesterday as well. Flight to quality, or flight to safety, I should say, with the gold bugs not really happening right now. We're well below that 50% Fibonacci level as of right now, but it is finding a lot of support at that 200-day moving average that will act as a support level as well. So we're kind of really stuck between a really strong resistance area of that 50 Fibonacci level, because it coincides with the point of control, which is where the most time and volume has been spent. That will act as resistance in a sense of getting well above that at this point. So we're kind of pushing sideways, which kind of falls into that filling in this little low volume node to kind of create a bigger bell curve, if you will. Then on to the bonds. Bonds just off a little bit by about 6 ticks. The 50-day moving average acting as support, bouncing into that 200-day moving average. So we talked about this. As the 50 crosses over the top of the 200-day, that is going to be more bullish momentum. This is seeing higher highs and higher lows as of right now, which would also indicate a more of a bullish trend. I don't see where the economics and the technicals are really jiving right now. The technicals are pushing higher, but the economic picture is really showing that the Fed would probably continue to raise interest rates, which would send bonds lower. Higher yields, lower bond prices. And that's not necessarily what we're seeing right there in the bond market. On to the Dow Jones. Dow Jones up nicely today, but not nearly gaining all of the losses we saw yesterday. Really a very tight day, inside day for the Dow Jones as of right now. The Nasdaq, remember, it was leading massively to the downside in percentage terms yesterday. Today really kind of settling down inside of what we saw yesterday's down movement. So that would lead one to believe that we still have possibly more downside in the Nasdaq. One thing to be said, it is a Friday in the summer. Summer markets usually have lower volume, and Fridays exponentially so, as we used to call it on the floor, a rush to the Hamptons, which basically all the traders kind of leave and go for the Hamptons for the weekend and aren't trading. The E-mini S&Ps up slightly on the day as well. Maybe more of a profit-taking kind of rally, but really have not had a whole lot of movement. If you look at this overnight, we did see a pretty big sell-off, but then this is probably a short cover rally in a sense, and then just settling down inside day, value area high, value area low, well inside of yesterday's value area high and value area low. Not a whole lot of opportunity for day traders to trade the market profile when it's set up like this. Now on to a few trades that I've done, and these are some of the trades that I've been doing in my IRA, and I haven't talked a lot about my IRA lately, but I've been getting a lot of questions in some emails about IRA trades and defining risk and legging out and things of that nature. Now, usually when I'm trading in my margin account, I'm not usually legging out of spreads, especially short spreads. And short spreads in my margin account are usually a little bit tighter to the overall market than I would in my IRA, because when I'm setting them up in my IRA, I'm trying to set this up like a synthetic naked short call in a sense. So when I'm selling that naked short call, quote unquote, I'm defining the risk by buying a call really high and out of the market for maybe a couple of pennies here or there, and still being able to sell that short call for about 30 some odd cents. And that's about where I would be selling it if I were naked in a regular account, but taking a little bit less of a credit by about 3 or 4 cents, which in all intents and purposes, that is a synthetic naked short, because I'm never going to really let this market rally up to that long call where the risk is defined. I'm not going to take that much risk on that trade. So when I'm setting this up, this would be a situation where I would be willing to leg out of a spread in a sense. So if we're looking at Starbucks, and Starbucks I had on the July short this 61 calls and then long these 64 and a half calls. Now, as you can see, when I sold these calls, they were trading around 30 some odd cents. So I sold this strategy for about 31 cents. Now, by buying that spread back in, I'd be paying 16 cents for the 61 calls and selling the 64 and a half calls for basically nothing. I'd almost be offering zero in a sense, because I tried working 15s and stuff like that, and it wasn't working out. Nobody was coming in and buying these, so it wasn't allowing me to leg out or get out of that spread. So then what do we do in a situation like that where nobody's going to come in and buy those calls that are way out of the money? I decided, you know what, if I could just go in and buy in my calls that I'm short, it really isn't going to hurt me to lose a couple extra pennies on those calls that are way out of the money. As a matter of fact, at that point in time, I might as well just let it ride out. If I'm going to have to sell that call for almost 0 or 1 cent, then 1 cent for that long call is a pretty good deal, really. It's got a high probability, or, I got a probability, not really a high probability, but, maybe a 10% probability that gets touched within the next 20 some odd days. Any percent chance, as a matter of fact, for just a couple of pennies is worth it. I've already collected 50% of my max profit on this trade by selling it at 31, buying it back for 16, and then maybe 2 more cents, making it 18 cents. It doesn't really hurt me to leave that call on. So that's a situation where I will leg out of that spread, kind of leave those long calls on for free, in a sense, is the way I'm kind of looking at it. Similar situation rises in XLK, which is another trade that I recently put on in my IRA. I did this yesterday in XLK on the sell-off. We've broken below yesterday this trend area and settled outside of it. We did it once before, but then popped back in. I didn't have the opportunity to get into it, but this is the technology sector ETF. Yesterday broke well below it with the massive sell-off in the Nasdaq we talked about. I added some short deltas because my margin account is very long tech, and I talked about that yesterday in the market commentary as well. So I wanted to add a little bit of short deltas, even though they're not really in the same account, to take advantage of a bit more of a sell-off. So in XLK, I did a similar situation to Starbucks. But in XLK, I still have on that trade. But I want to show you with inception of setting this trade up. Yesterday, we were slightly lower, but with a theta decay, it kind of is a pretty relevant scenario as it would be today. But yesterday, selling these at 34 cents, and I think or 34 or 36 cents, and paid about 4 pennies for the 58 calls to define that risk. Now, I'm not really going to let XLK go all the way up to 58 and let that defined risk strategy kind of work itself out. But if the situation were to come about, now it being up today, it doesn't really help that situation. But if the market were to move down by, say, from 55, let's call it, to 50, down $2 to 53. In a sense, these short calls that I have on would be 2 cents or $2 higher. So I'm getting, I'm short the 56s. So now it'd be trading around, they'd be up here. So they were going to be worth like 2 or 3 cents. Now I'd probably get out of it right around here. So maybe, so $2 move higher. So $2 move lower would make these around the 57s or something like that. So 50% of my max profit would have been achieved, right? So I'm looking at buying the 56s for about the 56 calls, which are I'm short for about 11 cents, maybe even 15 cents. I'd be looking to get out, and these calls would be a couple higher also. And as you can see, there's just no volume in there. There's a good open interest in there, but there's just no volume. And rather than selling these for 1 cent or almost zero in a sense, I'm going to be looking to probably just leg out of this, buy those 56 calls for about 15 cents. That would be right around 50% of my max profit, right? You add in that 2 cents that I might lose on those long calls, puts me about 17 cents, still really close to 50% of my max profit. I'm willing to go with that in order to have those free calls on now at that point. So just legging out of that spread in an IRA when I've defined the risk by just cutting the red tape in a sense, going along with the rules, but they force you into that type of situation in an IRA, which is just really silly in my eyes. But that would be a situation where I'm just going to leave those calls on, let them either expire worthless or have the opportunity when the market rebounds to capture some of that increase in value in those calls. All right. So I just wanted to clear that up a little bit. IRA versus margin account, when we need to define that risk, because the powers that be that don't trade think that just being short calls is way too risky. And that would be a situation where we need to just kind of leave those on rather than just get rid of them for nothing. All right. So that's about all I got for you guys today. Today's webinar is going to be on a poor man's covered put, which is creating a synthetic short position, but we are defining the risk in order to limit our risk. And it's going to basically have a synthetic stop in there that we can kind of ride out. We won't really get kicked out of it, but we will be able to create a situation where it's kind of like the poor man's covered call, or a long call with a collar, or a long stock position with a collar. This is going to be a short stock position with a collar, which means you are going to be buying a put to create the situation, selling a put to define that risk, kind of collect a little bit of credit. But because we're buying that put that's just slightly or a little bit into the money, there's going to be a synthetic stop loss in that strategy. So go to protraderstrategies.com, sign up for that. And if you can't take that, take it easy.